today's topic is your net income isn't yours. That profit margin at the very bottom of your net income, of your profit and loss, a lot of people are like, oh, okay, yay, this I get to take it and I get to do all the things that I want to do. I get to pay myself and I get to do things, but that's not actually yet what you need to do. There are a lot of steps and things to consider before you just say, I get to keep all of that net income. It has multiple jobs, and so let's kind of see what those jobs are. All right, so most commonly, small and medium-sized businesses are going to be set up as a C corporation or, sorry, not a C corporation, a Schedule C is what I was thinking in my mind. So Schedule C is going to be a solopreneur. So that form flows into your personal taxes. You might be an LLC, so you have multiple people in there that are also considered partners. And so that we also need to pay our taxes on our personal side. Or maybe you're an S corporation where you can draw wages, but maybe you don't draw all of your wages from all of the money from wages. So these are the kind of people that I'm talking about, because what actually happens in your tax return is we may file your business as a return, but everything flows over to our personal side. When we are employees, then what happens is the employer, they will pull your tax that you owe, plus they will pay a portion of your Social Security and Medicare. But that doesn't happen when you are self-employed, when you own businesses. You basically need to make estimated payments. We talked about that last week. So that's where these come in, these taxes. Okay, what about if you have a line of credit with a bank, or perhaps you have an SBA loan that you are paying off? Perhaps you have credit cards. So although you've already accounted for the actual expenses that have gone through, interest is accounted for in your profit and loss, but the actual principal payments are not on your profit and loss. So when you're looking at the bottom line, you need to consider that some of that money needs to go to principal payments. So let's say you have $5,000 in a line of credit payment. Well, 2,000 of that is going to show on your profit and loss because you may have interest on there, and then 3,000 is actually going to be on your balance sheet. So just needing to make sure that we hold that money. You also have owner pay. So again, kind of going back to the taxes, depending on how your company is structured, if you there's a little bit more free range when you take or don't take money from the business. And so owner pay, that is drawn from whatever is left over, and you can take it. And then equipment and reinvestment into the company. So those big assets that happen not every year, but can be utilized as tax strategy to purchase equipment because we can get this paper of depreciation. But when we buy that large piece of equipment, that actually doesn't go on our profit and loss. What that goes on is our balance sheet. And so having the capital to be able to make a down payment, or if you paid cash fully for that item, whether it is a trailer or a truck or an excavator or something else that your business utilizes, those are going to be also how what numbers are coming from your net income. And then we have kind of like hidden drains. So the loans and the owner draw and taxes, those things for the most part are like, okay, well, this already happened, and so I owe this. But we also need to consider that a lot of our net income that we have needs to be for future things that may be irregular. So perhaps you know that you have to repair your water heater, or if you're going to be buying smaller items here and there that kind of add up over time that aren't your normal cost. Or if you're looking at potentially hiring someone. Hiring someone is great and it can work within it, but you really want to make sure that you take the time to set aside cash before that hire from your net income that you have, because it will just take time to also generate more revenue with that. And then, yes, cash reserves. So cash reserves are really important to plan for the future, to plan for these extra things that happen. If for whatever reason you do have a very bad month, you want to be prepared that you can cover your costs and not have to like fire people right away. We don't want that. So that's some hidden costs that we can also see. So instead of looking at your net income and thinking, yes, I got to just spend this all, we really want to look at it and start creating different buckets that you have. Because a lot of times when we're looking at our bank account and what our net income says, they are not equal. And all of the reasons we just covered are for that. So to plan and prepare for this, if you can create different buckets, so maybe a couple savings accounts, one for your tax estimated payments, because those only happen on a quarterly basis. You can set aside money for those. Perhaps for operating costs, you know you're going to have a heavier month coming up, a heavier season that happens within the summer months. We want to make sure that we can cover those, or reserves for slower months, for the winters, or whatever the cadence of your business is. So it's really just knowing that that net income is not your take-home number, that there are all of these other facets that we need to consider before saying, yes, pay me. All right, that's it. This was a quick one. Please reach out to help at All Accounting LLC. We would love to dive deeper into your specific numbers and see if we can help and change your trajectory of what you have for this year. We would love to, yeah, just understand and help you feel confident with your numbers. But this is it for now. So I do hope to see you next week, next Friday, 12 p.m. Pacific time. And I hope you have a great weekend. Thank you, guys.